the dashboard is really meant to be the heartbeat, or the epicenter, if you will, of how we see the world, how we see the market, translated through unbiased, independent analysis. And you'll be amazed at how simplistic, as we go through some of these slides, but yet how obvious, due to the numeric valuations deteriorating, how it was probably fairly obvious that this correction was coming, or that the market was vulnerable to a correction given the weaker underpinnings of the marketplace. So this is a close-up look at what your headlines and alerts on our dashboard would give you. And over time, we'll be adding more sort of unique criteria, but you'll get your aggregate new timing signals. So when you log in, it's going to say today in FusionIQ, there are 8 new positive timing signals, and in this case, 101 new negative signals. And the casual observer will notice throughout time that when the market is good, you're going to see obviously a imbalance with more positive timing signals than negative. And when you're in sort of a neutral market, they may sort of mirror each other. And then, of course, as things start to deteriorate, you'll start to see more one-dimensional, technical-only negative timing signals. The other thing I think which is interesting, and we'll get into this later, but it gives you an indirect approximation of the market. So when we're looking at individual stocks, we consider greater than 70 to sort of be the more favorable decile classes, 70, 80, 90, 100, if you will. So of course, then tracking how many stocks in our IQ universe are ranked greater than 70, or i.e. perceived to be good, is clearly something that's important to track. And just to give you an idea, when the market was really racing ahead in 2013 into 2014, I think the S&P was up 30 some odd % that year. On average, we were north of 1,500 stocks with a master score, 4-dimensional master score greater than 70. So that meant a lot of stocks were doing really well. As you can see, presently, there's only 181 stocks out of about 4,500 that have a rank greater than 70. And if you're in the system every day and you're looking at this headline and alerts every day, you start to see that degradation. So I'm only showing you what now is probably the lowest value I've seen, in a couple of years. But had we flipped this table 15 months ago, you would have saw a big number. But the point is you have to pay attention to these things. You have to see that, because what it's telling you is how is the foundation of the market as translated through how many stocks are ranked highly in our master score, i.e. being good. And obviously in a good market, it makes common sense that more stocks should be doing well. And in a transitional market, a trading range market, you'd see less. And then, of course, as you are about to correct, you'd continue to see more erosion under the surface. So, but this is a quick way for you to, as a user, see the first sort of leg of that stool. If we go down, and this is the one I love the best, and we talk about it around the office, and for those of you who have been on our calls before, we always used to like to say, we have strong market opinions, but they're loosely held because things can change. Data can change. Inputs can change. You could go out today, the weather's great, and tomorrow you could have some cataclysmic weather event. So you can't just be locked into a forecast. What I love about the beauty of the sector watch table, and these are the 11 major market sectors as done by Morningstar North American industry code classifications. So we have 11 sectors, technology, all the way down to energy. Now, when you're aggregating, and again, this is another roll-up like the ETF scores. So what we do is we take every stock that's considered part of the technology group, every stock that's part of the healthcare group, and we come up with a simple average to get that score. So for a sector score, since you're never going to get a 90 sector score, because with a broader swath of stocks, you're always going to have enough poor ones and things of that, or neutral rated ones to keep the average score low. So for our sector watch threshold, if you will, for kind of determining good and bad, we use 55. So just looking at this, you've got not one sector out of the 11 S&P sectors presently greater than 55 IE, which would be considered strong. So not one. And we're going to look at just as recently on the next slide of December 15th, comparative to where they were then, where they were now. And they had deteriorated quite a bit then as well, and clearly had flashed some signals. And what I like to say is if somebody catches a cold, that's one thing. It's not really that bad. If somebody else catches a cold, it's no big deal. But it can quickly go through the system, and all of a sudden everybody has a cold. When everybody has a cold, it's a problem. Corrections, shallow corrections start, of course, when in a shallower correction or normalized correction, you're always going to have something strong, something hold up. But when they start hitting everything, that's when you're starting to get more into, a scarier correction, if you will. And as we looked on December, I'll go to the next slide now to do the comparative of what the sector watch table looked like on December 15th versus now. And you'll see at that particular point, we had technology at a 60, we had consumer cyclical at a 55, consumer defensive at a 55, right on the threshold of good versus bad. So let's call it 8 out of 11 sectors were less than 55 on 12, 15, 15. Now, for a reference point, when you get off this call, look at where the S&P was, or some popular index, or some stocks in your portfolio on 12, 15, 15, and look at where they are now, and you're going to see a significant difference. I had penned a Fastlane commentary. For those that are subscribers, you can look it up, December 15th. It was called Special Edition Fastlane Market Update. And I talked about the large number of timing cells versus negative timing signals versus positive signals. I talked about the fact that there were only several hundred stocks ranked greater than 70. But then looking at a broad swath, looking at the whole market, and then I said 8 out of 11 sectors are below our 55 level, or i.e. have caught the cold, the virus. And to me, there's no holy grail, and that doesn't mean I'm right, but I always err on the preponderance of evidence. And if 8 out of the sectors are weak and only 11 are strong, that to me is a pretty good indication that there's significant deterioration. And if you want to go a step further, you're calling consumer cyclical and defensive on 12, 15, 15 basically about to cross, because they're right at the 55 level. So you could almost call it 10 out of 11 at that point. But, to be transparent and with the numbers, it was 8 out of 11 below 55. And so we were starting to write in our commentary and sort of pontificate that the data is stacking up against you. The data is suggesting the path of least resistance is down, et cetera, et cetera. Now, if you translate that to where we are now, and before actually, if I go back to the sector watch table on the left, I want to point out and look at the 30-day change in master score, with the exception of a couple that were flat, -4, -5, -3, -4. So not only were only 8 out of 11 sectors falling, but their composite sector master score from the previous 30 days was also had a negative delta or a negative change. Compare that to today. Like I said, now we have no sectors that are greater than 55, and you can look at that two ways, or as I like to say, you can look at it two ways. At some point, when things get overly bad, you reach that capitulation, that washout level, et cetera, et cetera. However, I look at it at this level because, we're 5 years from 09, or well, more now, 6, 7 years off the low as we head into 2016. And generally speaking, with fits and starts, if you look at a chart from 2009 lows to present, it's generally up and sloping to the right, with some struggles along the way. But it's been a 6, 7 year bull market for the broad market. And we're at higher levels than we were in 11, 012, 010, 09. And you're getting this massive sort of breakdown, 11 sectors negative out of 11 now from higher levels with, if you wanted to give it some context, a bull market that you could say is a little older or past historical norms, with the median averaging so many days, this one being beyond that. And so you start to put that mosaic together, and you can see it translate through the data, which I love, because it allows me to filter out all the noise when somebody says, oh, earnings are going to be good, or that's going to be good, or this could be great. That's all subjective opinion. Nobody really knows. The data doesn't even know, but I don't make the numbers. The numbers make themselves, and they translate the market action. So I can see the transition from strong to mixed to weak.